Learning how to invest is like learning how to fall in love. You have to experience it yourself, make mistakes, and grow from them. While you can't truly master it in school or through a course, there are lessons that can save you a lot of heartache, both in relationships and in investing. Over the past 13 years, my portfolio has compounded at an annual return of over 30%, focusing on long-term buy and hold stocks while avoiding high-risk, short-term plays like options and crypto. But in my early years, I made plenty of mistakes that kept my returns mediocre. Today, I want to share with you 7 key lessons that can help you navigate those early years, kind of like getting through your first breakup so you can achieve market-beating returns sooner. First, in my opinion, the most important skill for success in investing is the ability to control your emotions. The market is driven by greed and fear, and if you let them dictate your decisions, you'll often end up making the wrong moves. When the market is soaring, fear of missing out kicks in. You feel the urge to buy, thinking maybe this time it's different, even when all signs point to overvaluation. On the flip side, when markets crash due to major events like global pandemic or geopolitical crisis, fear takes over. You panic, wanting to sell everything, convinced that it's the end of the world, but in reality, these events often have little long-term impact on the businesses you're invested in. Everyone knows the golden rule: buy low, sell high. But when emotions take over, when things get exciting or terrifying, we tend to do the opposite. Recognizing these emotional patterns and training yourself to react rationally has been one of the biggest contributions to my success as an investor. An example, during the peak of the pandemic in March 2020, the market collapsed. While many investors panicked and rushed to sell, I remained calm and held my positions. Most of my investments were in tech stocks like Tesla, Amazon, Facebook, and Zoom. Companies I believe would remain essential even in lockdown. People will still shop online, use social media, and rely on video conferencing tools. Tesla, with its strong brand, would also continue to generate demand. Instead of selling, I took out a loan and devised a plan. I would dollar cost average into the market every week for a year. By November 2020, the market had fully rebounded to the pre-pandemic levels, and that year became one of the best investment years for me. Next, studies show that many investors fall into the trap of selling their winners too early and holding on to their losers for too long. A simple yet effective strategy to counter this is to let your winners run and regularly trim your losers. Even if you write only 50% of the time and all your losers go down to zero, letting your winners run can result in gains that far exceed 100%, multiplying 2 times, 3 times, 5 times, 10 times, or even more. These gains can more than make up for any losses. On the other hand, your losers are like weeds, draining valuable resources that could be better invested in opportunities with higher potential returns. Trimming your losers not only frees up capital, but also allows you to claim tax benefits if you've realized capital gains earlier in the year. I know it can feel discouraging to sell stocks when you're down on it, but trust me, once you've trimmed all the losers, you'll feel a sense of relief and peace. Your portfolio becomes like a beautiful, well-maintained garden filled with thriving greens that bring joy just by looking at them. It's a strategy that doesn't just improve your portfolio's performance, but also your zen as an investor. The biggest and often overlooked form of loss is opportunity loss. What happens when you sell a stock and it keeps climbing? In many cases, opportunity losses can be far greater than the losses from holding on to a losing stock. I take this concept seriously and track every stock I sell. I keep a detailed Google Sheet logging not only what I sold, but also what I did with the proceeds. My goal is to evaluate whether the decision to sell and reinvest was a net gain or loss. Ideally, the stock I sold should have dropped, while the stock I bought afterwards should have risen. However, sometimes the opposite happens. I sell way too early and the stock continues to soar. That's why I regularly review my tracked transactions, and if an opportunity loss becomes too significant, I reevaluate the stock and consider rebuying to correct my mistake. For example, in 2013, I sold Tesla at $6 split adjusted after it had tripled. At the time, I thought I was locking in solid gains, but Tesla kept on soaring and I quickly realized my mistake. Fortunately, I rebought the stock and is still able to capture much of the incredible 200 times growth. Many investors dismiss these situations, saying things like, "It was never meant to be," or it's never a mistake to take a profit. Stop it. Sometimes it is a huge mistake, like selling after the stock triples when it's on its way to a 200 times return. Without tracking these opportunity losses, I might not have had corrected that decision and could have missed out on one of my best investments. Next, let's debunk a common myth. You don't need to find the next hidden gem to make money. Many investors waste time chasing tiny, microcap stocks, hoping they'll become the next Amazon or Tesla. The reality? These companies are incredibly risky. Most are likely to go to zero, then deliver the life-changing returns. Instead, some of the best investments are in companies that are already doing well. Take Amazon, for example. I bought it in the mid-2010s when its market cap had just surpassed Walmart at $247 billion. Even though it was already a dominant player, it still had massive room for growth. Today, it's worth $2.4 trillion, a nearly 10 times increase. The same holds true for companies like Apple, Microsoft, and Tesla, which continue to deliver strong returns long after becoming household names. However, and this is a big however, not all established companies are good investments. What sets the great ones apart is a moat. A moat is what protects a company from competitors. It can be a strong brand, patented technology, network effects, economies of scale, or customer loyalty. Companies with wide moats can maintain pricing power, fend off competition, and continue growing even in tough economic conditions. So instead of chasing speculative stocks, focus on established businesses with strong competitive advantages. Not only do they have a proven track record, but they're also far more likely to continue growing and delivering solid returns over time. Investing isn't just about picking great businesses. It's also about making sure you're paying the right price. A strong company with solid growth can still be a bad investment if you buy in at an inflated valuation. In most cases, owning a great company is more important than its valuation. Strong businesses tend to grow into their price. However, there's a point where even the best company becomes too expensive, and knowing how to value a company helps you recognize when that happens. A great starting point is understanding the price to earnings ratio and the price to sales ratio. The PE ratio compares a stock's price to its earnings, while the PS ratio is useful for evaluating companies that aren't yet profitable. These two simple metrics can help you avoid overpaying. Take Uber as an example. When it IPO'd in 2019 at $75 billion, it was a strong brand but unprofitable and burning cash. Investors who understood basic valuation saw it was overpriced, and sure enough, Uber traded below its IPO price for years. By learning valuation fundamentals, you can avoid hype and focus on strong businesses at reasonable prices. Even great companies can be bad investments if you overpay. After 20 years of investing, I've learned one key lesson. I'm not good enough to time the market, and neither is almost anyone else. Many investors believe they can sell a stock at its peak and buy it back lower. But market timing is an illusion. To succeed, you must do two things. 1. Sell at the top before it drops. And 2. Buy back at the bottom before it rebounds. Even if you had a 50% chance of getting each step right, your odds of success would be just 25%. But reality is worse. 80% of the time, when the stock market hits new highs, it keeps going up. That drops your success rate to just 10%. And if that doesn't convince you, another statistics that I want to share is if you miss the best 10 days in the market over the last 30 years, your total returns would have been cut in half. Trying to time the market increases your chances of missing these critical days and therefore reducing your returns significantly. This is why my approach is to just stay invested in great businesses. Time in the market beats timing the market. My final tip, read less news. Or better yet, stop reading it altogether. News is designed to provoke fear and anger because that's what gets attention. Constant exposure to negative headlines can cloud your judgment, leading you to make impulsive buy or sell decisions based on emotions rather than logic. However, not reading the news doesn't mean ignoring important trends. You should still stay informed about technological advancements, industry shifts, and emerging products, the things that truly shape the market. In fact, cutting out the noise of daily news might free up more time to focus on these long-term trends, helping you identify where the real investment opportunities are. Before we wrap up, what are some of the key lessons that have helped you succeed in investing? Share them in the comments below. I'd love to hear your insights. A quick disclaimer. I may have positions in the stocks discussed in this video. Do not buy or sell any securities solely based on what you hear today. Always do your own research or consult a financial professional before making investment decisions. Thanks for watching and happy investing!